FOMC highlights, Fed keeps rates on hold, Warsh says, won't hesitate if inflation persists. That single number resets the trending playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. That's not the story. The story is what Warsh said next, and why it resets the entire inflation conversation for 2025. Let's start with the surface. The FOMC voted to keep the federal funds rate unchanged, holding the line at 4.25 to 4.5%. That's consistent with the pause that started in December. Markets had priced this in. No surprises there. But buried in the statement and amplified in the press conference is something much more significant, a conditional threat that changes how you should think about the next 6 to 9 months of monetary policy. Warsh, during the FOMC remarks, was direct: we won't hesitate if inflation persists. That's not a routine policy comment. That's a signal. And here's why it matters. For the past 2 years, the Fed's communication has been dominated by one word: data dependent. They watch the numbers. They move when evidence demands it. But Warsh's phrasing flips that slightly. It's no longer just, we'll respond to data. It's, we're ready to act decisively if you don't cooperate. This distinction matters for 3 reasons. First, it signals impatience. The Fed cut rates 3 times in 2024, in September, November, and December. Each cut was supposed to ease financial conditions and cool the economy gradually. But inflation has been sticky. It hasn't fallen in a straight line. And now, 3 weeks into 2025, Warsh is publicly saying, if this stickiness continues, rate cuts are off the table. We can go the other direction. That's hawkish repositioning without moving rates today. It's a preemptive warning. Second, it changes the incentive structure for markets and businesses. Investors have been betting on a lower for longer scenario: rates stay low, spreads compress, growth assets outperform. Warsh's comment doesn't kill that narrative, but it adds an asterisk. If you're a fund manager or a CFO building a 2025 forecast, you now have to price in tail risk, that the Fed might hold or even hike if inflation surprises to the upside. That changes your cost of capital assumptions. It affects buyback programs. It affects hiring plans. Third, it's a message to the Treasury and fiscal policymakers. The Fed doesn't directly control inflation, it controls the money supply and credit conditions. But inflation is also driven by fiscal stimulus, government spending, and supply-side shocks. By signaling won't hesitate, Warsh is saying to Congress, in effect, don't test us. If you keep spending and inflation stays elevated, we will tighten again, and it will hurt. It's a soft constraint on fiscal expansion. Now, what actually changed in the statement itself? The language shifted slightly on 2 fronts. The Fed removed some dovish phrasing about the path forward and reaffirmed that rate cuts are only appropriate if inflation continues to move toward the 2% target sustainably. That word, sustainably, is key. It means 1/4 of good inflation data isn't enough. They want to see a trend. They want durability. And right now, they're not confident they have it. Let's look at the numbers that prompted this. Core PCE inflation, the Fed's preferred measure, was running at 2.8% as of December, still above the 2% target. That's down from 3% in November, so there's progress. But it's not the kind of steady decline that would justify another rate cut next quarter. If you're the Fed, and inflation is holding in that 2.6 to 3% range while growth remains resilient, you're not in a cutting mood. You're in a wait-and-see mood. For India, this matters in 2 ways. First, rupee dynamics. A more hawkish Fed, even a tentatively hawkish Fed, tends to strengthen the dollar. A stronger dollar makes imports more expensive for Indian businesses and puts pressure on the rupee. If you're a manufacturing exporter in India, your margins get squeezed when the dollar appreciates. If you're a student planning to study abroad, tuition costs rise. If you're an RBI policymaker, you have to think about capital flows. Warsh's comment doesn't trigger an immediate dollar surge, but it extends the timeline for dollar strength, which is already a headwind for India. Second, policy coordination. The RBI is watching the Fed closely. If the Fed signals higher for longer, the RBI is more likely to hold its own rates steady or cut more cautiously. That affects lending rates in India, which affects loan affordability, which affects consumption. So a Fed that's conditional on inflation determines, in part, how much breathing room the RBI has to support growth in India. Globally, this matters for every central bank. The Bank of England, the ECB, the Bank of Japan, they're all watching the Fed's reaction function. If the Fed is ready to hike again, other central banks will have to recalibrate their own paths. That's a synchronization risk. And it's one reason this FOMC hold with a warning is more significant than a routine rate hold. So what should you monitor in the next few days? 3 things. 1. Inflation data. Any release showing core inflation ticking up will validate Warsh's caution and likely push rate cut expectations further into the future. 2. Market repricing. Watch the 2-year yield, which prices near-term Fed policy. If it rises sharply, that's the market saying, okay, I believe Warsh. I'm repricing the next 18 months. 3. Fed speaker commentary. In the days after FOMC, other governors usually clarify and expand. If they validate Warsh's tone, that's confirmation. If they soften it, that's a signal the hawkish talk was just one voice, not consensus. The bottom line, the Fed didn't move rates today, but they signaled they're ready to move up if they have to. That's not as exciting as a rate cut or hike, but it's more important. It resets expectations, tightens financial conditions without moving the funds rate, and tells you that the era of easy policy might be over, even if we're not in a tightening phase yet. This is the Fed's way of saying, the ball is in inflation's court now. Give us sustainability, or we will respond. That's the real story from today. Subscribe for daily intelligence on how central bank policy, inflation data, and macro signals reshape markets, your investments, and your earning power. Find the full analysis at atlassignal.in.